So merger and acquisition, right? Merger and acquisition is, of course, when one company buys another company or one company joins with another company, right? So the two of them represent a form of business combination, right? It forms a group of accounts, a group of companies, where we have a business combination where two or more companies join together to become one enlarged surviving entity. One enlarged surviving entity. In your SBR, they will call it uh, one reporting entity, right? So that's it. Now, the arrangement involves the consolidation of assets, liabilities, and business operations into one company. I believe you understand that. Your
Mm-hmm.
merger, when you consolidate the finance, when you have two or more companies together, where one is a parent, the other is a subsidiary, then you can have something like what do you call it? Consolidated financial statement. Where you consolidate who is that person now? Someone also came in with a rain with rain. I don't know. The person just came in and it started sounding like there is a rain falling over there. Please mute yourself if you know your place is not silent or the place is noisy. Please mute. Okay. So merger and acquisition is an arrangement that involves consolidation of financial statement, consolidation of assets, liabilities, incomes, expenses, and business operations into one company, right? Now, the company, that one company may be the original margin entity, and it may not be the original margin entity. What do we mean? It can be the parent company that is consolidating, and it can be one of the subsidiaries. So that's it. Now, the types of merger and acquisitions we have, right? In business world, companies are buying themselves. Yes, companies are buying themselves. You have the horizontal merger, right? An horizontal merger is the companies that are in the same line of business. They produce similar goods, they provide similar services, and they decided to come together. That's horizontal, right? It could be like one person is buying the other, and it could be like two of them decided to operate together, right? And that's where we have example of Standard Chartered Bank and IBTC Bank. Chartered Bank and IBTC, right? And two of them are forming Stanbic IBTC. Yeah. So that's it. Now, we also have a vertical merger. And vertical merger occurs between businesses in the same industry. Yes, they're also in the same industry. But one company supplies goods to another company, right? So you decided to buy your supplier or you decided to buy your customer, right? We have an example of that as a soft drink company that merges with another bottling making company, companies that are making the bottles, and companies that is selling drinks, soft drinks, right? Two of them merging together. Like instead of me buying plastic from them, let me just merge with them. Or instead of me selling the drinks to them, I can buy the company and make it mine. So we have something like that as well. Now those things are merger, they merged together. We also have acquisition, right? Where one company purchases majority shares in another company, right? Aha. And that's where company A acquires more than 50% of shares in company B, whereby company A is a parent company, company B is a subsidiary. I don't think I need to stress so much on that. We are all aware, we understand that before. Am I right? Hello, are we there?
Yes, sir.
Yes, sir.
Yes, sir.
Okay, that's it. Now, the benefit of merger and acquisition under tax. The benefit of merger and acquisition is that it improves management. Yeah, merger and acquisition improves management. All right. Yeah. Uh, then also it results to economies of scale. I believe you know what the economies of scale is, right? Economies of scale. Do we know what economies of scale is? Or
Yes,
I
sir.
should know
Yes,
it.
yes, sir.
Yeah, now. So economies of scale, yeah, it results to economies of scale. It results to growth of a business. It's a faster way to grow a business, right? It results to tax shield as well. Yeah, there are some things that you'll be shielded from paying tax from. Yes. Then also it increases your market power. Of course, you have more access to the market. And then it improves financing. You can get more finances from the bank. And also you can diversify and reduce your risk. That's what we have there. Do you have any question? Hmm? No question. Okay, take that. Okay. Now,
Sorry, sir.
yes,
Sorry,
sir.
sir. Hello.
Yes, ma'am.
Please, sir, how do merger and acquisition shield tax? Like, how do you use merger and acquisition to shield tax?
Okay. So for merger and acquisition, number one, let me take from the aspect of tax holiday. Priority companies. Do you know what priority companies are?
Yes. Companies that produce essential commodities.
Priority companies, essential commodities. What are priority companies? Anyone? And what's the former name for it?
Is it pioneer, sir?
Uh-huh. It is definitely Pioneer.
Okay.
Yeah. So now for Pioneer companies or priority companies, right? Now, there's a certain level of employees you must have before you can get that tax holiday. All right. Yeah, there is also a value of non-current assets you must have. Now, when you merge two companies together and two of them become one, of course, you'll be able to claim tax holiday if you have the required assets. All right. So that's it. You have tax holiday when you have the required asset like that. Does that explain it, please?
Yes, sir.
Okay. Now, the power of FIRS or NRS. The power of NRS in your merger and acquisition. NRS has a sale. Who is that person? Please mute. Please. That person should please mute. Shall we proceed, please? Okay, yeah. Now, before you can do any merger and acquisition or transfer or restructuring of a trade or business, before you can do any of that, you need the consent of NRS. Do you understand? You must obtain their consent, including clearance regarding any capital gains tax that may be due. Any capital gains tax that may be due. Yeah, you need that. Then also, the CETA mandates that no merger can be consummated without NRS's direction, right? Yeah, it's a rule of NRS, and clearance concerning any tax due and tax payable. So you must have that. Now, the tax implication of merger, acquisition, and takeover. It depends on the specific arrangement between the companies, right? For instance, when a new company takes over an existing company, when a new company takes over an existing company, right? That existing company will cease operation. Do you understand? That is, you apply cessation rule. And then the new company that is just coming on board will start as a new company and take a commencement and adopt a commencement rule for the new business, right? So that's it. Are we there?
Yes, sir.
Okay, so that's it. Now, since the company is a new company and you have applied commencement rule, the cessation rule for the old company, commencement rule for the new company, the new merged company take over, right? The new company that has acquired, the acquiring company. Hey. Now you have to file annual returns of that old company, that company that has ceased operation. Don't forget your cessation rule that says that you must file your return within 18 months. You must file your return. You must notify NRS of that for cessation. They have to pay their tax within the next 6 months, right? Am I right? Have you not
Yes,
done
sir.
it? You've done business
Yes.
period now? So now the new company has to file annual returns within the first 18 months. The new company, within the first 18 months of incorporation or 6 months after the first accounting year. All right? Yes, you must do your annual filing, whichever is earlier. Commencement rule applies. There's nothing like initial allowance. There is nothing like investment allowance as well for the assets transferred from that seized business to the new business, to the acquiring company, to the new company that has been formed, right? There is nothing like initial allowance or investment allowance. Do you understand? Do you even know why there's nothing like that? Now, the assumption is that you have purchased those assets on second-hand basis. An asset purchased on second-hand basis, they don't apply initial allowance or investment allowance on them. Am I right, please?
Yes.
Yes, they are
Okay.
existing assets.
Yes, sir.
Yeah, I like that affirmation. I'm very glad, honestly. So that's it. Now, annual allowance is based on tax written down value of those assets. The annual allowance is based on tax written down value. And unabsorbed losses and capital allowances of the merging company are not carried forward. Do you know why? The company that has ceased operation, their unabsorbed losses and their capital allowances are not carried forward. Do you know why?
If for capital allowance, for you to claim capital allowance on an asset, it must be used rent wholly exclusive reasonably for that business. Then
Mhm,
it must be the business that own the assets before you can claim
mhm.
capital allowance on it, sir. Thank you.
Okay, I like that point too, but that's actually not my target. I actually have another way. Now, let's focus on the company that is ceasing operation. We are saying that that company that is ceasing operation and this company that is buying it, the loss and capital allowance from that operation that has ceased, you cannot carry it forward to this year, to this new business. Apart from the fact that it is not this business that use the asset. So they cannot claim the capital allowance. Apart from that, is there any other reason?
I think it's carried on cessation. Is it backward for 4 years or so?
What is that thing you are carrying backward?
The capital allowance is carried backward.
Thank you very much for that. You are absolutely correct. Capital allowances can be carried backward. For that company that ceased operation, they carry it backward. That is, if the company ceased operation in 2025, you go to 2024, 2023, 2022, and 2021 to relieve the existing capital allowance. But anything you cannot relieve up to that 2021 becomes a terminal loss. Now, what about the losses, unabsorbed loss? What happened to the unabsorbed loss?
Unabsorbed loss for a
Is deemed,
seized business cannot be carried backward.
It cannot
is
be
deemed
carried
loss. Is deemed loss on cessation.
Do we call it deemed loss?
Terminal loss.
Thank you. That's the
That's
English.
another name for unabsorbed now. Terminal loss. That's on cessation.
You
There is
called
deemed
it,
loss.
they also call it deemed loss. Okay, this is my first time of hearing deemed
No,
loss.
we are said is deemed loss. That is being regarded as lost. That's
And it's
nothing
a
can be
loss.
done
Okay,
again.
it is deemed loss. Okay, I thought
Loss,
you
yes.
meant that it is also known as deemed loss. No, it's known as terminal loss. It becomes a terminal loss, right? Yeah, it becomes a terminal loss. So since it is not a terminal loss, you can't carry it forward. But the capital allowance, you can have the tax written down value. Remember, you can claim annual allowance, but you can't claim initial allowance on it, right?
Yes.
Aha. So that's it. Now, that's why we are saying that you cannot carry it forward. All right. But of course, you can add it to tax written down value. The capital allowance can be added to tax written down value of the asset for annual allowance purposes. Hi, that person, please mute. Unrelieved capital allowance will be added to the tax written down value, right? And that's that. Now, stamp duties may apply to the share capital of the new company. Right? Now, it's a new company, of course. So, yeah, stamp duty we apply on their share capital. Major costs incurred due to professional and regulatory involvement may be disallowed as capital expenses. Yes. Professional fees, all your regulatory costs, right? Regulatory process you had to go through in order to complete the whole process, the whole margin process is not capital expense. VAT and withholding tax applies to the fees you have paid for professional services related to the merger. Of course, that one is normal. The new company may be required to provide a guarantee or security for the payment of any tax due by the seized company. That company that has ceased operation, you have to pay their tax, or you have to give us a guarantee that the tax will be paid. And end of service awards, gratuity that you pay to employees in that old business, that seized business. Gratuity, compensation for loss of employment are all allowable expenses for this new company. All right, so that's what we have there. Now that is the new company buying an existing company. What about an existing company taking over another existing company? Now, the company that is being taken over is also deemed to have ceased operation. That means cessation rule will apply. And the absorbing company continues as an entity without commencement rule. You are already existing. Cessation rule applies to the company you have purchased. But there is no commencement rule. You continue living your life. Now, the absorbing company continues as an ongoing entity, right? Now, there's nothing like investment allowance, no initial allowance on transferred asset. Annual allowance is on tax written down value. You continue with the annual allowance, right? Then also, unabsorbed losses and capital allowance of the margin company may also not be carried forward. Now, it may not be carried forward But tax authority, when you have a discussion with tax authority, they can carry it forward for you. It depends, but most times it is not carried forward. Are we there, please?
Yes, sir.
Good. Now, also, fees for professional services are subject to VAT and withholding tax. Stamp duties apply to any increase in share capital. Increase in share capital. Increase in share capital because it's an existing company. So stamp duties can apply to, we definitely apply to their shares. Now, that's the second scenario. The third scenario is a merger resulting in the cessation of businesses of all the merging companies. As we are merging together, two of us are ceasing operation and we are starting afresh, just like partnership, Abby. Am I right?
Yes, yes.
Yes.
So just like partnership. Now, in a situation like that, cessation provisions apply to companies that have ceased business permanently. Two of us that are ceasing business, cessation applies. Right?
Yes.
Yes, sir.
Unreleased capital allowance at cessation can be carried backward and set off against the assessable profit of 5 years preceding the cessation year, 5 years preceding. Then unrelieved losses at cessation cannot be carried backward, of course. Sums received or paid after cessation are deemed to receive on the last day of cessation. Yes, that's the normal rule. Are we there?
Yes,
Yes,
sir.
sir.
Okay, that's it. Now, if we have a trade or business that is sold or transferred, right? Business sold or transferred. Now, when there is a trade or a business is sold or transferred to a company in Nigeria with assets and one company has control over the other, or both of them are part of a recognized group, you transfer your business. You transfer your business to a Nigerian company. For instance, there was this merger whereby, what's the name? Is it Total? Total Energies. They sold their business last year now, Abby. Am I right? Hello?
Yes, sir. We are there. I don't know.
Yes, sir, you're right, sir.
Okay. They sold their business last year and a Nigerian company bought it. There are so many other businesses that sold, was it last year or 2 years ago, 2024? Many companies did not sell last year, but I think Total sold their own last year, early last year. From 2024, I think they completed that sales last year, early January. But I don't think any company also sold. After that, those ones that initiated this since 2024, I don't think anyone initiated anything in 2025. Because 2025 companies boomed. Many companies enjoyed. And many companies enjoyed. But we are not going into that. Now, they sold it and a Nigerian company bought it. When the Nigerian company buys a company like that, what happens? Commencement and cessation provisions do not apply. It is transferred to a Nigerian company. It is a transfer or a sale to a Nigerian company that is existing. Right? Now, there is no commencement rule, there is no cessation rule. It's just like a change of management. Assets sold or transferred are deemed sold for an amount equal to the residue of the qualifying capital expenditure. We assume that the amount you sold it, ma,
Hello,
auntie, are you with us? Are you talking to us? Now, that company that is sold, it's assumed that the amount you sold it is what was given to you, is the value of the remaining qualifying capital expenditure, like the tax written down value of that company. That's the value at which you have sold, you have bought the business. And also, the acquiring company is not entitled to initial allowance and is deemed to have received all allowances granted by the vendor company, by the company that is selling. You have received all the allowances. That's why we call it the qualifying expenditure, right? That is the amount you sold it is equal to the qualifying capital expenditure. Are we there?
Yes, sir.
Sorry, sir. Hello, sir.
Go ahead, sir.
But are we going to charge annual allowance on it?
Yes, we charge annual allowance.
Okay, okay. Thank you.
Wait, annual allowance on the asset that was sold? Eh?
Do you want transfer? The transfer also.
Asset that has been transferred to you.
Yeah.
It is assumed that you have claimed all the annual allowance.
Okay.
Yes, you are not claiming annual allowance on this particular company again. You are
Okay.
on that, the assets you inherited from them that is transferred to you. You can't claim initial allowance, no annual allowance, because it is assumed that you have received all the
Oh.
allowances.
Okay, okay.
Right?
Thank you.
So all the allowances, but what if the annual allowance, the assets still have tax written down value? If the
Okay.
assets have tax written down value, you can continue to claim the
Annual
remaining
allowance.
written down value.
Okay.
All right. So that's it.
Okay.
Now, when we have a reconstituted company, that person should mute. But I think it's your network, sir. You can, I mean, it's from your side. You can mute now. Reconstituted companies. For companies incorporated to carry on a trade or business previously run by a foreign company, right? You are carrying on a business that was formerly run by a foreign company. Commencement and cessation provisions do not apply. Assets are also due to be sold to you for the residue of the qualifying capital expenditure. So you cannot claim initial allowance. All relief laws of that foreign company are deemed to be incurred by the reconstituted companies during their first year. Since it is a reconstituted company, you can claim the losses of that company that was transferred to you. That foreign company you purchased in Nigeria, you can claim all the losses. It's because there is no cessation. So it's like an existing company. The company is still existing. So that's it. Now, you can mute, please. You can mute. Tax planning options for merger, acquisition, and takeover. We've not done tax planning in this class, right? Have we? Have we done tax planning?
No, sir.
Don't think
Okay.
so.
Okay, when we get to tax planning then. Now, there are tax planning options as well. And the first one is that merger consideration that is paid in shares is not liable to capital gains tax. If you pay for your merger companies, right, you pay the existing shareholders with shares. Even if there is a gain in that share, you will not pay CGT. Do you understand? You will not pay capital gains tax. Also, capital allowance is claimable on transferred assets taken over at market value with NRS consent. All right? So any asset you purchase at market value with NRS's consent, yes, you will claim your capital allowance on it. Now, your tax, you as a taxpayer, your option under SITA should also apply favorably. You should apply it favorably. Unrelieved losses of individual companies can be carried forward to the new company. And also, rollover relief can be claimed for investment of proceeds from the sale of assets. Where do we have rollover relief? Where?
Capital gain tax.
CGT. Thank you, sir.
Okay.
CGT.
Thank you, ma'am. So that's it. If you have any rollover relief, then you can also apply that. Now let's go into tax audit and investigation. We have 45 minutes to end this class. Abi? Yeah. Wait, oh. What time did we start? 9 o'clock, right? Yeah, we still have 45 minutes. Now we have tax audit and investigation. Tax audit is an annual audit. It is done and don't let me say it is done. Anything that has to do with tax authority, I don't trust them, and I'll never vouch for them. So it's meant to be carried out. It's meant to be done every year on all taxpayers. Please, I'm begging, please, just mute. Thank you.
No, excuse me, sir. May I ask a question, please?
Go ahead, ma'am.
Please, sir, I have difficulty in this, the last one we treated before this tax audit and investigation, where
Okay.
this the context that is talking about tax concession on business reorganization and reconstruction. So there are some points raised there that I do not understand, please.
Which one, please?
He said the commencement and cessation provision are not applied. This thing called concession, is it concession between the taxpayer and the tax authority, or concession between one? And there are
Where is the
there
concession?
are conditions.
I can't find the concession you're talking about. Where is the concession? Or reconstituted companies?
Yes, sir. The concession on it and the condition for granting such concession.
Where is the
There are
concession? I
okay,
can't
don't
find.
worry, sir. There are some subtopics under it like that. Okay,
I'm coming.
don't worry, sir. Okay.
Wait, hold on. Are you reading from your I Can Study Pack?
No, I'm reading from the note I jotted from
Which
the
page?
pack.
From the pack.
Yes, but I'm
Okay.
not with the pack right now.
You are not reading. Okay. If you know how it is, but you wrote it down.
Yes, sir.
Okay, go ahead. Under what topic? Merger and acquisition.
Yes, under merger and acquisition.
Is it
But
under the various scenarios?
under reconstructed companies.
Okay, reconstructed companies. Okay.
Yes.
So read it out.
The point there, under the concession is saying that the commencement and the cessation provision are not applied.
Yes.
Then the next one says, for capital allowance purposes, the assets sold or transferred shall be deemed to have been sold or transferred at an amount equal to the residue of the qualifying expenditure thereon on the day following such sale or transfer. Then the next one said the company acquiring the assets shall not be entitled to any initial allowance thereon and shall be deemed to have received all the allowances already granted to the vendor.
Okay.
Up to the date of the sale or transfer.
And which one exactly you don't understand? Is it everything?
No, there is still another one that is talking about the condition to be met before such concession will be granted.
Okay. What concession? So everything you've read out now, there's nothing like concession here.
Okay.
You've not mentioned anything concession. You just want to read condition before concession can be done. Conditions to be met before concession. what is that concession before going to the conditions that will allow that concession?
Okay, the one I read out is the concession, but
Okay, concession for reconstituted companies, Abi.
yes.
Okay, now that is it. Now, is it that you don't understand all those concessions?
No,
All
I
those-
understand. No, I understand the content. What I do not understand is it before before reconstructing the company that they will now, the taxpayer and the tax authority will enter that concession.
What is reconstitution? I mean, what is reconstruction?
Reconstruction.
Yes. I think I know what you are saying. What is
It's
reconstruction?
under sale and transfer of a company. It's under sale and or transfer of a company.
I'm asking you now. What is that reconstruction? When there is a reconstruction, what does it mean?
I don't understand.
You don't know what reconstruction is?
That's what I'm thinking, that is about selling or transferring a company, then maybe it is wrong.
If it is wrong, it will still not be under what's it called?
Merger and acquisition.
Merger and acquisition.
Okay.
Right? So which means it is still under merger and acquisition. What do you understand by that reconstruction? Do you have anyone here who can tell us what reconstruction is?
Okay, sir, may I
It's just
try?
like business reorganization, when usually happens when there's a business combination or merger and acquisition, whereby a formerly existing company or a company has to reorganize its capital business due to the merger.
Anyway, someone wants to try again.
Yes, sir. I think it is a business, a company who is into business before but is not incorporated. So later now, when it is being incorporated, it means that it is restructuring. So,
It's just forming of another new company.
Sorry?
I said it's forming of another new company.
Okay. Forming another new company from where?
From the existing one that is merging together as one.
Do we have anyone else who wants to try? See, yes, reconstruction is also an act of merger and acquisition. But what type is reconstruction? What differentiates reconstruction from others? I don't know if you understand.
I think it's from existing businesses.
Okay, from existing businesses to what?
To form an entirely new company.
Okay, so let me try.
Oh, yeah, try now.
I think reconstruction, when it has to do with business, is just to try to reorganize the business structure, like all aspects of the business.
All aspects of the business,
like their finance and every other thing.
We can also say is a way.
I can't hear
Is
you.
a new way. We can say is a way of running a newly formed organization. How many share of the existing one, or the one acquiring this one of your 4 of your share will equal to one of the new company they are forming, their assets and liability, how they are going to match them together.
Okay, so this is it. Reconstruction and reorganization is that ownership, the business is still existing. The two of you want to match together without ceasing operation. Do you understand? You want to come together, you want to match together with none of you ceasing operation. Are we together? That is
Yes.
reconstruction and reorganization. Do you understand? Now you transfer your business to another business, or two of you come together. And you're coming together will not mean that one of you is ceasing operation. Two of you are coming together. There's nothing like cessation. You continue, or instead of separate entities, you come together to become a single economic entity. Reorganization can also be in form of splitting, two of you being together before, and then splitting to stand on your own.
So, sorry, sir. Meaning that both commencement and cessation rule will not apply
to any of them.
Okay.
So it can come in form of merger, whereby company A and company B will come together, and then they become company AB. They continue like that. They don't cease operation. They don't see themselves as a newly commenced business. They are all in the same industry. It's just like expansion, just like constructing a new building and expanding your sites. That's it. Okay. It can also come in merger and acquisition, whereby you purchase the assets in the existing company. You just purchase it and you continue to exist like that. No cessation, no commencement. Right? It can also be in form of amalgamation. At least you can remember amalgamation from partnership business. Two partnership businesses coming together to become a single partnership business. You remember that? I did partnership account. Like I wanted to break at the point. So amalgamation, that is reconstruction or reorganization. And just like I said, two of you who have been together before decide to split and become a separate legal entity. No commencement, no cessation. You continue to exist as if you've been existing before, separately. Do you understand that now?
Yes.
So that's why we are saying that there is no initial allowance. There is no cessation, no commencement. It's like it's an existing company which will continue to exist.
Thank you, sir.
Madam, do you understand that now?
Yes, sir. Sir, please, what I was asking for is on the park, page 535.
Go ahead and read it, don't worry.
Okay. The condition for the concession is qualification for exemption from commencement and cessation rule in a business restructuring amongst related parties to now include requirements to be related for a period of at least 1 year prior to the restructuring.
Okay.
Number, no disposal of assets.
Let's take that. Now, that one is saying that you qualify to be exempted from commencement rule and cessation rule.
Okay.
Do you understand?
Yes, sir.
There's nothing like commencement rule. You are exempted from commencement rule. You are exempted from cessation rule. Right?
Okay. Yes.
Insofar, it now includes requirements to be related, Abby. So at least before 1 year to that restructuring. Do you understand?
Yes, sir.
So now, The qualification is that you are exempted from commencement and cessation rule. And that's different from related parties.
Okay.
Do you understand?
Yes, sir.
Aha. Now, insofar that you have been related for a period of 1 year before that restructuring,
Okay.
you have been related before. Now, you guys have been together. That is, you have merged together for more than a year. Now you want to separate. You've been in existence for more than a year. Now you want to separate. If you want to separate, you are qualified to be treated to be exempted from commencement or cessation rule. Not that you started the business now, and after 6 months, two of you want to be on your own lane. You want to be separated from each other. If you are not up to a year, then commencement and cessation rule must apply. But if you are up to a year, then you are exempted from commencement and cessation rule.
Okay. Okay. Thank you, sir. I understand the other points.
Uh-huh.
Thank you, sir.
So now, the other part will now be that if you dispose any of your assets before 1 year, if you dispose any of your assets before 1 year, then we'll treat you like a new business.
Okay.
So which means you must not dispose any of your assets before 1 year. If not, that exemption will be revoked.
Okay.
It's just like some companies, I can't remember. Like, okay, another example is this real estate companies, investors in real estate. Investors in real estate are to share up to 70% of their profit within 12 months if they don't want to pay tax on it. I don't know if you remember, we did it in this class.
Yes, sir.
So that's the same thing here. Now, for two of you, you must have been together for up to a year before that restructuring. And during that restructuring, any asset you acquire, any asset you inherited from that restructuring, you cannot sell that asset within the next 1 year.
Okay.
If any of you sell the asset, then that company is a new company. Then they will treat you as a new company.
Okay.
Now, all these threats, don't mind me for calling it a threat, though. All these threats, right? They used to be valid when we were using the old, what do we call it? Old commencement and cessation rule.
Okay.
Do you understand?
Yes, sir.
You agree with me that in the whole commencement rule, you can pay tax on a single profit 3 times, 3 years for 3 years. Am I right?
Yes,
sir.
happen.
Yeah. So because of that, they are threatening you that if you like, do this one, you will pay tax, you will pay, you continue to pay. But right now, even commencement rule are on preceding year basis.
Yes, sir.
So that threat will not really work again. There's really no cost for commencement anymore. There is no cost. But even before commencement rule, under commencement rule, you enjoy, what do we call it? Right of election.
Yes, sir.
But right now, there's nothing like right of election again. So that's what we are saying here.
Okay.
Are we together?
Thank you very much, sir.
Yeah, you're welcome. So that's that. Now let's go into our next topic. Tax audit and investigation. The same audit like every other company. Audit is independent examination on your financial records, Abby. In the same vein, tax authority, they are supposed to have a tax audit and investigation department. Right? And what that department does is to take every taxpayer and audit their tax remittances, tax filings for every year. Like all companies are going into audits now. Tax audits. Auditors, tax authority should also have auditors that will be auditing the tax paid by all taxpayers. Now, when I say taxpayers, the major focus is on company income tax, right? So take their financial statements, take their audited financial statement, compare it with the tax they paid. Did they actually pay all their taxes, all the tax dues? Or have they been doing mago? Do you understand? So that is a statutory audit. It is required. It is required by law to be done at least once in a year by tax authority. You can see we call it statutory audit. Yes, tax audit, we also have it there. All right. Now, before then, we look at statutory audit generally, whereby you audit the financial statement of the company and express your opinion on whether it shows a true and fair view of the financial state of the company. Yes or yes? Yes, Abby? Yes, I'll take it as yes.
Yes.
Now, the objective of statutory audit, that as you have it in your AAA, is to ensure proper books are kept, right? Verify the financial statement, agree with the books, confirm the compliance, adhere to applicable accounting standards, and confirm that financial statement gives a true and fair view. Abby? Yes, all those things are there. That one is your audit. It's not me. Now, we also have specialized audit, right? Which is conducted when special attention is needed on specific issue, or when someone reports a case of fraud or something. Yeah, that's where we have specialized audit. That all these ones, they are still in your AAO. Now, the legal basis for tax audit. Tax audit is also similar to a specialized audit, and it is additional to statutory audit. So usually, the tax authority will not audit your account until there is suspicion. All right. Yes. So they will conduct audit on your tax payments with the approach and scope of work different from the normal audits in your audited financial statement. Normal audit performed by auditors. No, their own is different. All right. Now, the legal backing for conducting tax audits is found in various provisions. We have it in CETA, we have it in PITA, we have it in PPTA, we have it in VATA, we have it in Stamp Duties Act as well. All of them, yes, you will see evidence from those acts that says that audits should be conducted on your tax payment. The objective of tax audit now is to ensure adequate accounting books are kept for determining your taxable profit and loss and the tax paying. We should ensure that, yes, there is an accounting record you have kept and you are paying tax based on that accounting record. You verify, tax authority is also to verify your tax computations, right? They have to confirm your compliance with applicable tax legislations. They have to educate you as a taxpayer. They discourage tax evasion, right? They detect and correct accounting and arithmetical errors in your tax returns. They provide feedback to management on tax law provisions and then recommend changes, right? They also identify cases of tax fraud or investigation. And of course, they encourage voluntary compliance. And of course, they support self-assessment scheme. Self-assessment scheme is you doing your audit by yourself, Abby. Am I right, please? Am I right? Yes, I'm right. I hope you are still in this class and I'm not the only one here.
Yes, sir. Well, yeah.
Are we recording? Yes, we are recording. You guys should not scare me. Okay. Now, there's a difference between tax audit and investigation. Tax audit is legally required and it's a routine that is done annually, periodically, right? To confirm the accuracy of taxpayers' self-assessment. The tax you have paid, your self-assessment, your basis period your computation of tax computation of capital allowance, your computation of company income tax, tax authority is to confirm that you are correct. That is under tax audit. Tax investigation is not routine. It is only when there is a suspicious case of fraud. All right. So it is conducted when there is suspicion of fraud or tax evasion. Tax audit can be very narrow, right? It's narrow. They just focus on few things, confirm it, confirm your computation, and then we move. Right now, the tax audit and investigation is very simple. I don't know if you understand why. Tax audit is now very, very simple. Very, very simple. How? Since you are using Tax Pro Max, the only thing I need is that I should confirm that everything you have inputted in your Tax Pro Max is what is in your bank statement. I mean, in your audited financial statement, AFS. If it is the same thing, then I don't have any issue because the Tax Pro Max is automated and there is no error. Ordinarily, error should not occur. Right? So that's it. So the tax audit is very narrow and it's less detailed. It doesn't have much details. It's just to check. You can complete it under one or 2 days. But tax investigation involves a broader scope and it is more detailed. You can do tax investigation for a year. Yes. You can do tax investigation for up to a year. Can be looking at it, why is it that much? Yes, it can be that much. Now, the purpose of tax audit is to ensure compliance and accuracy of your tax returns. But tax investigation is to uncover fraud, tax evasion, right? And then to gather evidence for prosecution. Remember, if you cheat tax authority or you evade tax, you shall be prosecuted. Am I right?
Yes.
Yes,
Good.
sir.
So tax audit is conducted by regular tax auditors. But tax investigation is conducted by tax inspectors with special training, sometimes involving police assistance. You don't know anything. So police is involved because it can lead to prosecution. And that's it. Now, the authority and power is that tax auditors have limited powers. But tax investigators can seal your business. They can obtain your documents. They can obtain your document that is necessary to prove tax evasion. They will ask you for documents so that they can prosecute you. They use it as evidence in the court of law, and you must give them. So that's it. Do you have any question? Any question on that? Okay, now I'll take tax audit department. Now, tax audit department is a department within NRS. Nigerian Revenue Service. All right. Yes, and they also have it in State Board of Internal Revenue. And they are responsible for conducting tax audits. Guess what? Many states, I'll not mention their names. Many states don't have this tax audit department. Or let's say they have tax audit departments, but they don't have staff there. So what they do when there is tax audit or investigation is to call on a tax consultant. Yeah, they call on a tax consultant. All right. And the tax consultant will do the job for them. They pay the tax consultant and the rest is history. Now, the NRS has a National Tax Audit Department at their headquarters and regional tax audit unit at regional offices. All right. Yes, they have it. Now, the types of tax audit we have. We can have a desk audit, we can have a field audit. A desk audit is what your auditors do, that they will not come to your office at all. They just ask for your financial statement, and from their office, they will do the audit without necessity of coming down to your office, visiting your office location, confirming the existence of your physical assets, verifying the existence, verifying the existence of your non-current assets, confirming your liabilities and your other non-current assets like your debtors, your bank, and the rest. They'll just sit in their office and they'll complete your audit. That audit is called a desk audit. So for tax authority to, yes, they conduct desk audit. And this desk audit is that they look at the returns you have submitted to their office. All right, they conduct the tax returns submitted to the office. So they do routine examination on it for completeness to ensure that you paid the complete amount. And of course, if there is any error in computation, they will look for that. And then they accompany it with document. That's what they do. Right? Now, this results in a tax audit report or query letter to the taxpayer when they see that there is error or the account is incomplete, right? So they will serve you a query letter or an audit report, and that can lead to possible reconciliation meetings or additional assessment. So when they see that, they'll send you a query letter and then they will schedule a reconciliation meeting with you this time around. They are not coming to your office, or you are the one going to their office. Don't pray for any reason for tax authorities to come to your office. It's not a pleasant experience, except if you are very sure. There are some of us that we have faced them multiple times, and we know they fear them again. When they say they are coming, we buy drinks. We order chicken and we order fried rice and chicken for them with drinks. So that when they come, they chillax and do whatever they want to do, because we know they fear them again. It's sure for us die. So that's it. All right. Now, that is a desk audit. Now they can conduct a reconciliation meeting. A reconciliation meeting is that they invite you to their office. They have a meeting with you, discussing those discrepancies they have observed in their reports. All right. And that's it. So when you look at it, it can lead to additional assessment. That is, if you have paid less, it can lead to additional assessment. Now, that's that on the desk audit. We also have field audits. Please, are we there?
Yes, we are.
Yes, sir, we are.
Maybe only me waka come, abi?
No be only you.
Eh?
No, sir, we're here.
Okay. Now, for field audits, that one is more elaborate. So they will come down to your office and they will thoroughly examine your documents in your office, and they will have direct interaction with you. They will come down to your office in flesh and blood. So they'll be asking for the documents. Don't forget, the desk audit, for the desk audit, they will make use of the documents you have already submitted, your filings, your documents, right? That's the only thing they are checking. They are not asking for additional documents. But for field audits, they will ask for the documents you have submitted and those ones you have not submitted. They'll come to your office to ask for it. And they will thoroughly examine those documents. All right? And we have different stages for that field audit. Now, desk audit is not that much. For your field audit, yes, It has about 7 steps or so. I mean, it's up to 10. No? That's about 10 steps. Do we have any question? Do we have any question on this step? Do we have any question on what we've done so far? On audit and investigation. Okay, so I'll take these stages involved in the tax audit. All right. Once I take the stages, then we'll call it a day. Now, the first stage we have is to select the taxpayer. So they will just, they can do random, anyhow they want to select, right? Now, what they do is that they select taxpayer majorly those who are requesting for tax refund. Those of you who are looking for tax credit, they start with you. You are looking for tax credit, Abby. Let's see if you have even submitted the actual report. So that's it. Once you request for it like this, you are in soup. They'll come to you for tax audit. Secondly, so that's one of the ways they can select a taxpayer that they want to audit. All right, and it can be a taxpayer who has who is always recording loss. Every year you don't make profit. Every year your own business does not make profit. How about now? Or those companies that they have low adequacy ratio. So they select based on that. Then number 2, the next step after selecting a taxpayer is to go to preliminary review of that taxpayer's file. They check your account, they check your profile, all your basic information, they check it. All right, they do analysis on your returns. They look at the RIC, they look at the audit strategy and all of that. They can say, let's go for this one. All right. Then once they are coming for you, they will notify you. They'll send a letter to you. Right? They'll send a letter to you for the audit. They'll tell you that, okay, you are coming to your company for an auditor. They'll tell you the dates of the commencement of that audit. They'll tell you the tax officials that are coming for the audit as well. All right. Now, after that, they will do a pre-audit meeting with you. Pre-audit meeting. And here, that is, they come into your office. They'll have a management meeting with you. They will inform you of the tax audit purpose. They confirm the background information from your company. They gather relevant information and they will seek your cooperation. They will introduce their members as well. After that, after having that meeting with you, they've given you the date, they've communicated everything to you, right? They will now come for the actual field audit. Hi. That field audit is just like your auditors. You'll be buying rice and chicken for them every time they come. So after the initial meeting, they will come for the field audit. And in that field audit, they'll review your documents, your information, the information you have provided. Right? Your request for additional, they will request for additional documents where necessary. They will seek for explanation for some of your items. All right, and that's it. Then, aside that, they can also have a post-audit meeting with you. All right, and a post-audit meeting is that once they are done with their findings, their audits, they will have another meeting with you to discuss their findings, what they discovered during their audits, and they will seek for clarification on any of the issues. Right? They will discuss it with you. After discussing it with you and requesting for the explanation, then they will now issue an interim audit report. They will issue an interim audit report based on their findings. They will let you know that based on our findings, oh, this is it, oh, you are required to pay this amount and all of that. That report is not signed yet. They just want to carry you along so that they will know whether you agree with it or not. It is at that point they do all the mago. I'll know now how much can I pay. Then that's where they negotiate. All their mago, giving you a private account. That's where they do it. It is at that point. So after the interim audit report, then we also have a post-audit review by their regional headquarters. After you and them, you have agreed on that audit report, then they will send that audit report to their regional office and headquarters after you guys have finalized and negotiated. All right. So now they review the report at the regional level or headquarters, and they will make necessary adjustments where needed. Then, after that has been done, they will now call you for a reconciliation meeting. They will discuss the differences with you. They will finalize the audit findings. All right. And after that, once you and them, once all of you agree, then of course, they will issue the final audit report. They will issue the final audit report. And that final audit report will now carry their audit findings and their conclusions. Do we have any questions? So all of these are mentioned. Do you have any question, please? Any question? In the absence of question, we'll continue from here in our next class. Good night, everyone.
Good night, sir.
Yeah, good night.
Good night.